Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 31st of March. Let's dive into the week's stock market news. US auto tariffs overshadow positive European signals. European financial markets experienced a disappointing week, ultimately retreating despite starting on a positive note, buoyed by encouraging economic updates and geopolitical developments. The Pan-European Stocks Europe 600 index finished approximately 1.4% lower in local currency terms, primarily due to renewed trade tensions initiated by the United States. Performance varied across major national bourses, with France's CAC 40 index declining 1.6%, Germany's DAX falling 1.9%, and Italy's FTSE MIB shedding 0.8%, while the UK's FTSE 100 index managed a marginal gain of 0.1%. Market sentiment across Europe soured midweek following an announcement from US President Trump regarding new 25% tariffs on all automobiles and auto parts imported into the US, set to commence the following week. This comprehensive application, lacking exemptions for specific countries, represented a worst-case scenario for European exporters who had hoped for leniency. President Trump further escalated concerns by threatening additional tariffs should the European Union implement retaliatory countermeasures. This downturn overshadowed earlier optimism fueled by positive economic data and geopolitical shifts. Encouragingly, the Eurozone private sector marked its third consecutive month of expansion in March, with manufacturing production showing growth for the first time in 2 years, complementing the existing expansion in the services sector. In Germany, business confidence saw an uptick as the Ifo Business Climate Index rose in March to its highest reading since July 2024, supported by parliamentary approval for increased government spending on defense and infrastructure. Furthermore, positive geopolitical developments emerged early in the week, including constructive talks reported by Ukrainian President Zelensky between Ukraine and the US, followed by the announcement of a partial ceasefire with Russia. This ceasefire specifically targeted a cessation of naval hostilities in the Black Sea and a suspension of attacks on energy infrastructure. In the United Kingdom, Chancellor Rachel Reeves presented the annual spring statement, confirming further government spending cuts. Simultaneously, the Office for Budget Responsibility, OBR, presented a downbeat near-term economic outlook, having its UK growth forecast for 2025 to 1% and anticipating higher unemployment and inflation for the current year. However, the OBR did revise its growth projections upward for the years 2026 through 2029. On a more positive note for the UK, inflation eased slightly to 2.8% in February from 3% in January, sustaining the possibility of an interest rate cut by the Bank of England in May. Now our insight into alternative markets, EYE's energy appetite, reshaping Europe's power market and infrastructure needs. The rapid ascent of artificial intelligence, AI, is fundamentally reshaping power market dynamics, primarily through an escalating demand for data centers. Coupled with ongoing digitization and slower improvements in power usage efficiency, this trend presents significant implications globally. Within Europe, data center demand is projected to surge from approximately 10 gigawatts (GW) today to around 35 GW by 2030. Accommodating this new IT load necessitates staggering investments estimated between $250 billion and $300 billion in data center infrastructure alone by the decade's end, excluding the costs of additional power generation capacity. This exponential growth in data center infrastructure translates directly into a massive increase in electricity consumption. Europe's data center power usage is forecast to nearly triple, climbing from about 62 terawatt-hours (TWh) currently to over 150 TWh by 2030. This surge positions data centers as a primary near-term driver of electricity demand growth on the continent, expected to account for roughly 5% of total European power consumption within 6 years, up from about 2% today. Critically, driven by the net zero commitments of major operators, the bulk of this new demand is anticipated to be for green, low-carbon power. The demand originating from data centers is both immediate and substantial, potentially representing 15 to 25% of all net new European power demand added through 2030. This distinguishes it from the more gradual demand increases expected from sectors like electric vehicles or heat pumps. Between 2023 and 2030, the electricity required specifically for European data centers is projected to rise by approximately 85 TWh, reflecting a compound annual growth rate of about 13%. However, the entire European power ecosystem faces considerable hurdles in meeting this burgeoning demand. Challenges span limited reliable power sources, pressing sustainability requirements, inadequate upstream power infrastructure, land availability constraints, shortages of essential power equipment like transformers and generators, and a lack of skilled electrical tradespeople. Meeting this unprecedented demand requires data center operators to navigate a complex energy landscape, focusing on securing reliable, sustainable power. They face the challenge of energy intermittency, needing constant, high-uptime power, often requiring complex backup and balancing solutions, despite grid limitations stressed by integrating renewables. Operators must also secure vast amounts of CO2-free energy, frequently through power purchase agreements, PPAs, while addressing concerns about the actual decarbonization impact of instruments like renewable energy certificates, RECs. Furthermore, as grid connections become slower and more difficult to obtain, there's a growing imperative to explore on-site generation options, ranging from natural gas and hydrogen fuel cells to potentially small modular reactors. Strategic site selection, favoring locations with cleaner grid mix and cooler climates, can partially mitigate energy-related emissions and costs. Successfully integrating this massive new load is crucial if Europe aims to unlock its full economic potential and maintain digital competitiveness. The significant investments required could, however, offer a broader benefit by catalyzing essential upgrades to European power infrastructure, thereby supporting the continent's ongoing energy transition efforts. Addressing data center energy needs could help bridge investment gaps and accelerate the development of robust grids well connected to industry and households, aligning with goals like the EU Grid Action Plan. For transmission system operators, the mandate is clear: accelerate and increase energy infrastructure investments to ensure stability and reliability. Ultimately, the AI-driven demand for data centers represents a transformative force for Europe's energy sector. Navigating this new reality requires urgent, strategic choices about location, energy sourcing, and grid management, underpinned by substantial, coordinated investment across the entire energy value chain to foster a resilient, sustainable, and competitive energy future.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.